Hello, I'm Nikki Newton, President of UMB Private Wealth Management. Welcome to the 2025 Economic Outlook. Before we look at the year ahead, I'd like to thank you for your trusted relationship with UMB. The opportunity to guide you and your family through a lifetime of financial decisions is something we take very seriously. Over the past year, we've continued to make substantial investments to expand our teams and product offerings. In 2025, I am confident you will see the results of our team's hard work and dedication. Our passion for your success drives us forward every single day. And with that, it's my pleasure to introduce two exceptional leaders, Chief Investment Officer Eric Kelly and Director of Asset Allocation Dan Kiefer, bringing you this year's Economic Outlook.
I'm Eric Kelly, the Chief Investment Officer of UMB Bank. Welcome to our 2025 Outlook and Forecast. Joining me today is Dan Kiefer, our Director of Asset Allocation and Portfolio Construction. Welcome, Dan.
Thanks. Hello.
We're glad to be here today, getting ready to show you what we think is going to happen in 2025. As we record this, we're very close to the Christmas holiday in 2024. Some of the numbers on some of our charts and graphs might have changed slightly by the time you see this in early January, but our theme will very much remain in place. This time it really is different, some of the most dangerous words in finance for folks like Dan and I. 2024 has been an incredible year for us. The financial markets have had robust returns. At the time we're recording this video, the stock market is up roughly 29% total return year to date, so phenomenal returns. Inside of our complex, some of our own equity strategies have actually outperformed the stock market, so we're thrilled with the lucrative nature of what's happened in 2024 for our clients. Very thankful to have had a really great year on the investment front. But 2024 was an interesting year in several other ways. As everyone in the world knows, we had a very interesting election in 2024. President Trump secured a second term as President of the United States, only the second person in history to have a non-concurrent visit to the White House. Grover Cleveland pulled it off more than 100 years ago, back in the 1800s, and now President Trump has done the same thing. As this picture depicts, with the incoming president typically goes to the Oval Office to shake hands with the outgoing president. And the photos look nearly identical from 2016 to 2024. A lot of folks in the days after the election in November and December, there was in the air, wow, it feels like maybe it's 2016-17 all over again. But we are not in that camp. We think there's a number of differences. President Trump definitely has a new administration coming in, a full Republican administration taking control in D.C., and the markets have responded in nearly an identical way as they did in 2016. The stock market has rallied quite a bit since the election. Interest rates have been rising since the election results came in, just like 2016 heading into 17, but we feel that that's not the case now. 2024 heading into 2025, we believe, is quite a bit different than the previous Trump administration. This time really is different in several key ways that we think are important for how we prepare ourselves for how 2025 is going to unfold. And Dan and I, in the next 30 minutes or so, are going to cover the different areas where we think those key points are. We have the election, the interest rates, inflation, the deficit, the economy itself, just the condition of the economy, and the markets. All of those areas are areas where there's key differences between the first Trump administration and what the situation is with the second Trump administration that are very important for us to keep an eye on. Of course, we will finish it all up with what does it mean for your portfolios and your money, the most important question of all. So we'll work our way through the agenda by starting at the top. Dan, you'll start out with the election and where things might be a little bit different this time around.
Thanks, Eric. We have a chart or a picture of the Electoral College as it related to the state wins, and the only difference, administration over administration, is the inclusion of Nevada from an Electoral College perspective. But the big difference was, one, a much larger overall turnout, and then second, a popular vote win in addition to the Electoral College for President Trump. We think this is an important differentiator because it creates the condition of having a popular mandate around what exactly the administration is set up to accomplish in this upcoming 4 years.
Yeah, with a huge turnout and a big win on the popular side, that is important. In V1, during the first administration, he did not have the popular mandate, as they call it, because he didn't win the popular vote. This time, he won the popular vote by, at this moment in time, they say roughly 3 million votes, so he has what's considered to be a strong popular mandate. But that mandate is a key difference at really setting up, as we go through the rest of the presentation. In the previous win for President Trump, the number one concern of voters, as they report to the pollsters, Gallup polls and the Pew organization, before and after the election, voters said that their number one concern back then was they wanted the incoming administration to do something to stimulate GDP growth, stimulate the economy. And the economy was on relatively stable footing, and there seemed to be plenty of room back then for fiscal maneuvering. This time, heading into 2025, voters clearly told the people that polled them what their primary concern was with the incoming administration now was to solve the inflation problem. The average household is dealing with much higher prices in the world that they're living in, and folks are very concerned about it. And that's what voters say their number one challenge for the new administration is: solve the inflation problem. And with the new administration talking a lot about things like tariffs and trade wars, those things possibly could backfire on that mandate that the populace has assigned to them. So it's an interesting difference this time. And on top of that, the economy is in a different state, which we will talk about in some detail as we go through the rest of the presentation. During the previous administration, 16 and 17, the economy was relatively healthy and improving, so there was plenty of room for, you might say, aggressive fiscal changes. This time, as we will illustrate for you, the economy looks to be decelerating, so there's possibly quite a bit less room for maneuvering with aggressive fiscal maneuvers. It's a much different environment that could be quite a challenge for the incoming administration. So we'll start stepping our way through those key facts that we're talking about, where things are different this time, starting out with inflation. So Dan, this is a big one, a very big difference. Tell us a little bit about what the inflation situation is.
Sure. Well, the first step to solving a problem is defining it. So the first thing that we need to look at is what's the condition that we're entering into, and by comparison, what was the environment prior. We highlight the prior administration with the red box, and you'll notice that overall it was under the Fed's mandate and reasonably stable. The vertical bar there represents the recession we experienced associated with the pandemic, and then the wave of fiscal stimulus that came and created the buying spree and rise in prices that we saw shortly thereafter has come off the boil, but maybe is starting to turn up a little bit. The measure that we're showing here is core PCE. It's the preferred measure of the Federal Reserve to look at inflation overall, and removes the most volatile aspects of the inflation measure. When we think about this time versus last, we had a low and reasonably steady state prior. Here we have maybe calming down, but is certainly much higher, even higher than we would like to see it. We also have a difference in expectations. So this is survey of consumers looking 3 years out. What is the median expectation for inflation 3 years from today? And during the prior administration, we not only had a low level, we also had anchored expectations of continued low inflation on a go-forward basis. Today, that's not the case. So we have a higher level, and we have a higher expectation on a go-forward basis. And then rounding out, we have higher uncertainty. So we're entering into a space where we had a low level, we had a low expectation on a go-forward basis, and we had a low level of uncertainty, or we had certainty around the level of expectation going forward. And today that is all upside down. We have a higher level, we have higher expectations, and we have a higher uncertainty. So it's just there's a lot of change in the air.
A lot, and it's particularly given that this is the number one concern of voters the ones that gave him that popular mandate, this is their number one concern, and it's dramatically different than the first time they took office. So
different playbook.
It's a challenging situation on the inflation front. And tied hand in hand with inflation is always just the situation with interest rates. Interest rates are almost always simply a reflection of what's going on the inflation front. And the interest rate outlook and the current situation and outlook is dramatically different than what the first Trump administration had. It's the same setup on all these charts. The red box represents the first Trump administration time in office. And the line that you see in front of you here is the Fed funds rate. Probably the most closely watched rate in the world. It's the overnight borrowing rate that banks have as they lend to each other. It's controlled by the FOMC. When the first Trump administration took place, you can see that we had been in a long period of essentially zero interest rates after the great financial crisis. Interest rates had essentially been at zero for almost 10 years when the first Trump administration took hold. The Fed did try to normalize rates a little bit during the administration. They had a long, slow pattern of trying to get rates back up towards 2% to normalize things. It ended up being a program that didn't last. They had to start cutting rates again by the time we got to the end of the first administration. But you see on the right-hand side, the situation is dramatically different this time. As they come into office, the new administration is going to be facing a world of dramatically higher rates. Dan just told us the inflation story. Inflation had taken off. The Fed had to address that. So they increased interest rates by 525 basis points in one of the most aggressive tightening campaigns in history. Just recently, they've started to try to ease off of a little bit as inflation has started to come down. We do think with this dotted line you see here that they'll be able to ease through 2025 modestly, but only modestly. We think they'll end at around 375 at the end of 2025. But in aggregate, the interest rate environment is much higher and much more restrictive and probably much more volatile than what we had during the first administration. We want to look also to a more dramatic version of the story. When we talk about interest rates, we always have to talk about real rates because that's how economists look at it. That's how they look at it at the Fed. What is the Fed funds rate minus the inflation rate, real rates? That's the most important variable. And you look at this chart, you will see that for a very long period before the first Trump administration and through most of the first Trump administration, real rates were actually negative. They were below zero. So on that basis, it was one of the most accommodative periods in our history. That is considered to be extremely easy or accommodative monetary conditions. That's what they were dealing with, a very friendly environment that helps keep the economy moving. It was a very friendly monetary environment the first time. And on the right-hand side, you see what has happened to real rates as the Fed has tightened. It's been effectively an 800 basis point increase in real rates, one of the most dramatic in history, and it's a much more restrictive environment. Some folks would say this was one of the most severe tightenings of monetary conditions in history. That's what has happened just as the new administration is taking hold. Those are the types of things that can actually hamper economic activity pretty dramatically, and that's what they're inheriting as they take hold here, as the administration comes in here in January. So all of it, inflation, interest rates, a dramatically different situation than what they had the first time. And that takes us to the next very important section of the presentation, and that is the topic of the deficit, which has become a very contentious issue, Dan, and there's some important differences here.
Absolutely. So when you think about what has been transpiring is we've seen deficits that we have not seen before historically. I mean, even by a bipartisan tax policy group, the expectation of deficits over the next 10 years is something on the order of $7.75 trillion or almost $1 trillion a year, which really manifests in this accumulation of debt, right? So we have a chart looking at the total federal debt outstanding, which today stands at a high outside of war times, right? So outside of World War II, it has not been higher. And if things continue the way that they're currently trending, we'll beat that prior record. Something that we are obviously concerned as citizens. However, from a policy standpoint, it really only matters once people start to matter. And that's the entrance of these so-called bond vigilantes. So when we think about people who are bond buyers or sellers, the underlying issue is, will people continue to buy the Treasury debt when there is so much debt outstanding?
And we've talked about, like we see on the screen here, all of a sudden in the last 6 months or so, the headlines have shown back up. We've heard about the bond vigilantes throughout our careers at different times, but now this deficit thing has gotten so bad. Headlines right now since the election, the bond vigilantes are fed up. They're back and they're not happy. So we're not saying that at all that we think that there is a default event coming or anything like that, but it looks like perhaps the bond markets might become a lot more reactive to things that might increase the deficit more than expected. Do you think that's fair?
Yes.
Okay, it's going to add to the volatility that we're facing in 2025 on the interest rate side. It takes us on to the very next topic, which is a very important one. We said there were differences in the economy, and we believe that there are signals out there pretty consistently telling us that we think the economy might be on a decelerating phase. And we're going to try to illustrate that for you through the labor market, probably the most important area in the United States because this is a very consumption-based economy. We'll look first at the very simplest measure that most of us are familiar with, and that's the unemployment rate. People are familiar with that. You see it all the time. And during the first Trump administration, the red box, you see here, unemployment, the economy was relatively healthy and unemployment was relatively low and falling the entire time the first Trump administration was in office. So basically the labor market was getting stronger and stronger and stronger. The new administration is inheriting a different situation when you look on the right-hand side of the chart. The unemployment rate has been low, but it has been climbing. It bottomed at 3.5 and is now up in around 4.2 at the time we're recording this. And that is a large enough increase that the economists tell us an increase of this magnitude is typically associated with an unemployment rate that just keeps rising. Typically, if you have the unemployment rate go up more than 50 basis points, you are on the cusp of a recession or at least a serious slowdown. That is the situation we have as the new administration comes in. So there's questions around the strength of the labor market and the economy. We always want to look at leading indicators for the unemployment rate to see if those corroborate an expectation that maybe unemployment might continue to rise. And that is indeed what we see. Those who follow some of our research have seen these two charts numerous times in the past. The quits rate on the left is a widely followed variable, is a good leading indicator of what's going on with unemployment 6 to 9 to 12 months from now. This is the percentage of the labor force that can voluntarily separate from their job to get another job in any particular month. I call it loosely as the job hopper index. And it has been falling. And it's been falling steadily, and the key thing is it's fallen below the red line that you see in the middle at 2.3. That is the normal rate that we had in place before COVID, and it has fallen well below that. And historically in the United States, when the quits rate has fallen this low, below average, we have been in a deceleration and oftentimes heading into a recession. On the right-hand side, you have another one called the job openings rate. The Fed has been talking about this recently. Several of the Fed governors have been talking about this very variable. And the job openings rate has declined a lot over the last year or so. And the critical thing there is, again, the red line there at 4.5. The job openings rate is sitting right around 4.5 as we record this. It has fallen to that level. And two of the Fed governors just within the last few weeks have stated that the Fed is concerned that if that number falls below 4.5, which it looks like it's going to do, and you can see in quotes here that it would probably cause a spiral point of unemployment, meaning rising unemployment if it falls any further. So some signals are in place that the labor market is weakening and will continue to weaken, including that unemployment rate. And we have some new things happening now, too. We just thought we'd throw some recent quotes in from things that have just happened just at the end of the year. Corporate America has had what they're calling a rising wave of these mandatory full-time return to office mandates. Everyone back to the office 5 days a week. It's been popping up in corporate America, and folks are talking about it being, as it says here, a convenient way for employers perhaps to execute headcount reductions without having to pay the cost of layoffs. That's out there in the news headlines these days, and the incoming administration has some folks working hard on government efficiency, and they were speaking on this point, and the quote at the bottom came from some folks in the incoming administration. They're planning on doing the same thing with some of the federal government jobs, and these policies could provoke a wave of voluntary terminations, which we would welcome. So there's pressure out there that seems like the pieces are in place for the labor market to continue to soften and probably the unemployment rate to continue to rise. And we think that's what will be happening as we run through 2025. Dramatically different situation than the first Trump administration had on their hands. There's a few other headwinds that we want to go through here. And first, talking about just what we think is happening, an illustration of what I've been talking about. We do think that GDP growth is probably in a deceleration pattern. We think as we head into 2025, these are quarterly GDP numbers. We think we will fall below our natural growth rate, which is 2% in the United States. We think we're going to spend a period of time below 2% because of all the things that we've been talking about. And the decelerating economy is the opposite of what the first Trump administration had. They had an improving economy and an improving labor market. So it's a less friendly environment from an economic perspective than what they were dealing with before. The other big thing is the wall of consumption that we've been riding for the last couple of years has been funded probably in large part by the gigantic mountain of excess savings that we all had after COVID. A lot of dollars were pumped into the system by the Fed. Everyone kept their jobs during COVID, and people's savings ballooned to the trillions of dollars, as you see on this chart. This is according to the San Francisco Fed, and they've been tracking it as closely as they can. You can see on the right-hand side of the chart, they do believe that all of the excess savings from COVID burned off in the latter half of 2024. So that tailwind for consumption is probably gone as well. We have a weakening labor market, and we have the big consumption coming from excess savings probably gone. We think it points to a decelerating economy like I showed you on the GDP charts, and there's signs of that showing up right now. It's showing up right now in the credit card delinquency rates, and this is one of the first things you see when consumers are starting to come under pressure, which makes a lot of sense. It seems very intuitive. And this is a chart of delinquencies within the credit card space. Different age cohorts, every age cohort has exactly the same pattern. They're rising, and they're rising rapidly. And if you look across to the left, every one of these age cohorts is at a rate where we've only been in the last two cycles once we were in recession. So a lot of signals telling us that it would be wise to expect things to continue to decelerate as we head into 2025. This does not mean we automatically have a recession coming, but a deceleration, which will be challenging for the new administration. We threw in another quote here just because it was quite interesting. Just in the new earnings updates we've been getting from Wall Street, middle market retailer like Target. This is not the low end. This is middle America retailer, Target Corp. We all love to shop at Target. And just the underlying portion of this quote, they highlighted just in their most recent earnings release that they are very much aware that according to their customer base, consumers are shopping very cautiously and they try to manage household budgets. Another signal coming from the middle-class retailers that things are slowing a little bit, according to them. So it just corroborates our general theme. The economic momentum is quite a bit different than what the administration had their first go-around. All of that tells us things are more challenging, and it brings us to probably the hottest topic for the first 2 or 3 months of the administration is a lot of noise around this topic of tariffs. It's going to be a big deal.
It was sort of a defining characteristic of the first Trump administration.
Yep.
And there were, like we've talked about thus far, several tailwinds to the economy that afforded the opportunity to potentially hit some brakes with regards to the application of tariffs during the first administration that maybe are not as available today. You know, when we look at the first time this idea crop up, we had overall tariffs roughly double. When you look at the the weighted average tariff assigned to imports went from roughly 1% to 2%.
Which is a gray line on this chart, yeah.
Right. The current proposal is something very, very different. Talking about 60% against China and 10% overall. That would take the weighted average to an estimated 17. This is a much different magnitude than we experienced the first time.
And we have an economy that's not as resilient as it was the first time, but talk of tariffs that are much more draconian than the first time. It's an interesting challenge that we'll have to negotiate as we go through 2025. A lot of folks are struggling, meaning research firms are struggling with how to calculate what the impact of what's being talked about on tariffs might be. The folks at Yale University came up with the things on the next couple of pages here. The as stated 10% tariff on goods and 60% on China. Of course, it's designed to raise revenues to the federal government, and it would raise roughly $2.6 trillion over the first 10 years, according to Yale University. But that is only if the other countries do not retaliate with tariffs on us, meaning a trade war. And that type of retaliation could ultimately cut tariff revenues by as much as 12 to 15%. It's a very, very dicey dance that gets played when aggressive tariffs come into play. Folks are trying to estimate what the impacts would be on the average household, and there's a broad presumption that in the short run it would cause some inflation for the average household. Prices could rise for the average household because of the tariffs for all those things that we like to buy from over there, with maybe the cost being as much as $8,000 per household as a tax from the tariffs. So in the short run, it could increase inflation, which is exactly the opposite, as we showed you, of what the voters want from this administration. But then in the longer run, an actual trade war, most analysts agree, would reduce GDP for everyone, could reduce United States GDP by 0.5 to 1.4%. It's going to be an interesting game to see how it all plays out, because the magnitude of the tariffs are quite severe with an economy that's probably not ready for that. And of course, it's supposed to be offset, or maybe potentially offset, by cuts to the tax rates.
Yeah, there was certainly the opportunity available to reduce individual and corporate tax rates to stimulate the economy, to offset any negative effects from a trade war. And unfortunately, the environment today is such that the average corporate effective rate is something slightly north of 12%, and the headline rate came down during the last administration from 35 to 21. And so further cuts are likely a little bit pushing on a string, but certainly increasing the issues surrounding the deficit and debt. So we have a little bit of a vicious cycle that could set in if that was the lever attempted to offset a trade war barrage.
And what did you tell me yesterday when we were talking about this? For the corporate effective tax rate is actually around 13, and that's actually the average effective tax rate for the average U.S. household, correct?
Yes.
Right in that area. Not a lot of room to lower that a lot. And of course, as Dan said, if you start cutting tax rates here, maybe here come the bond vigilantes, because now you're impacting the deficit.
Right.
There's a real cycle that could unfold as we go there. The last topic that is super important heading into what do we do with your money is the financial markets. Valuations are dramatically different this time than they were the first time, and that is a very important factor as we go through all this.
Yeah, I mean, the performance of risky assets has been incredible, particularly the last 2 years. During the previous administration, we had valuations that would be characterized as right around average, long-term average price to earnings. Even if you looked at price to cash flow, these are sort of normal levels. And today, it's a much different story, right? There is some cause for additional valuation to come the way of the United States. Capital markets are much deeper and much larger here. There's certainly not a reason, or it's certainly not without cause. However, it just means that there's less room for a mistake or for a miscalculation. I mean, even when we look at high yield bonds, which is another way of thinking about risk, these are spreads against treasuries that are the tightest we've seen almost historically. And so this is just a measure of how well compensated are you for taking risk inside of high yield, and the short answer is, well, not well at all.
And we've been talking about this a lot. Just because the markets have done so well, the difficult side of that is perhaps they're ripe for turbulence if anything comes up to topple the apple cart. Yep. And this whole thing around tariffs could be the type of thing that sets off a daisy chain, and the markets could get pretty choppy around that. It's been an incredible run. Fair enough? Yeah. So we're going to summarize before we hit the final section. The key differences. First administration versus second administration on left and right. Inflation, before it was dead. and not an issue. Now, with the new administration, it is definitely resurrected from the dead, and it's going to be an ongoing risk and the #1 voter concern. Interest rates were 0. Now they're much higher, and they're restrictive, some would say. The deficit and the debt burden, they were rising and being talked about during the first administration. Now they are dramatically higher, at all-time highs almost, and they are a contentious issue. The economy, it was steady and expanding the first time. This time we see signs of deceleration, as we showed, I think, in great detail. And the market, as Dan just covered, before valuations were average, room for maneuvering there. This time, valuations are very, very rich, very full, which sets us up for possible turbulence for anything that comes up. The consequences of any miscues from very aggressive fiscal gymnastic is what I called it. It could be severe for both the economy and markets this time. It really is different. The bottom line for us is we're expecting market volatility to be quite high in 2025. This doesn't mean we're definitely heading into a recession. It means that we believe we got to be ready for elevated volatility because of all of these factors that we're talking about. And that brings us to the last section. What does it mean for your portfolio? Dan, I'd say take it away.
So, I mean, the important thing to take away from this is while there are plenty of things to be concerned about or to be monitoring, we're always climbing a wall of worry. We don't think that you should be underweight or running away from your long-term strategic plan, which should be anchored with a financial plan. We think that because there is not, our base case is not a recession, that any volatility should be met with buying, right? This should be an opportunity to pick up stocks on sale. So we're optimistic generally. We think that earnings could easily be 10% next year, and even with a little bit of decline in valuation, we still are going to expect a positive year for stocks. Just we think that it could be a much bumpier ride than the one we've experienced, particularly the last 2 years. We think that within equity, when you're taking risk within equity, that should be domestically oriented, particularly in mid-cap capitalization. We would fund that overweight from international, and that's predicated, again, on several strategic reasons, i.e. that the United States does have the deepest and broadest capital markets in the world, but also because earnings are set to grow the fastest out of between developed international and the United States by a factor of 30%. So 13% forecast for 25 versus 10% for EFI or developed international. We think that there's probably going to be a lot of volatility as these policy pronouncements get floated, and it's probably a act on the rumor or the tweet or whatever post, and probably a sell in the actual news or implementation of that, meaning that there's going to be an immediate reaction to something, and then by the time we actually get towards implementation of something, it's not going to be as protracted of a move. We also don't think that you should be sitting in cash for long periods of time here because Fed is likely reducing rates. And so as Fed funds starts to come down, cash is going to become less attractive. And in order to deal with inflation or really any long-term concerns, you need to have productive assets. Cash is not one of them.
All right, so as we head into the summary, we would like to remind everyone, we are long-term investors. We don't make quick or knee-jerk reactions to political or other headlines, for sure. We want everyone to stay anchored to a really well thought out, well-designed financial plan. That is the most important thing for all of us. We are trying to stay very disciplined in our rebalancing, and that helps all of us weather the storms of volatility that are probably going to stir up, particularly in 2025. We're going to be watching all of our events and valuations. That's what Dan and I do behind the scenes all the time. And we make moderate adjustments to our tactical weightings for sure. As this next year unfolds, severe volatility for us will probably be looked at as an opportunity to move deeper into the riskier asset classes, as long as we still believe we're not heading into a recession. So that's the bottom line for us. Our summary of our forecast for 2025 at this time. as we're recording this. Real GDP, as we said, is probably decelerating to something below 2%. Not a recession, but we probably spend most of 2025 in the world below 2. Inflation, as we talked about, if we do have a decelerating economy, inflation should fall down around that 2% number. It's red on this chart right here because that is a highly contentious forecast at this time. Some folks do think that there's a risk that inflation will move higher. We shall have to see. The unemployment rate, as we said, will be probably rising up to above 4.5. The Fed funds rate, I already said, we think 375 is where it will end this year. 10-year Treasury and also mortgage rates, we don't see them moving down that much throughout all this because inflation is still a threat. So we think the long end may not move much. As Dan just hit on, the S&P 500, we should still have the ability to generate positive earnings in 2025. And even with turbulence, we should have the ability to generate positive returns in the stock market. But we just have to be prepared for a bumpy ride as we go through. So that is the conclusion of our comments today. Thank you all for joining us. We thank you for being customers and friends of UMB. Here's to a great 2025.
Thank you, Eric and Dan, for your expertise and insights. This outlook is based on our team's careful study, decades of research, and passionate commitment to your success. In 2025 and beyond, UMB Private Wealth Management is here for you, cutting through the endless financial data and noise to offer true confidence and clarity for your future. Thank you for joining us.